Good morning, everyone. In consideration in setting retail prices, there are three components. These are customer price sensitivity and cost, competition, and legal and ethical pricing issues. When we talk about customer price sensitivity and cost, this is definitely a measurement of how much the price of goods and services affects customer willingness to buy a product. So, price sensitivity is one of the key factors affecting the company's pricing choices as well as its ultimate profitability. Nowadays, customers are well informed about product or service alternatives, product benefits, features, qualities, and prices through advertising. So, definitely, consumers are very rational to judge what they are getting from buying a product or service in exchange of their payments. Next is competition. Actions by different competitors integrate all elements of the marketing mix and do not focus on price alone. A competitor might make a change to a product or initiate a promotion that impacts customers' perceptions of value and therefore their perceptions of price. If you price your product lower than the competition, then your customer will value them less. Legal and ethical pricing issues. When we talk about pricing concerning legal issues, it is important and must consider to avoid illegal price fixing. A plain agreement among competitors to fix prices is always illegal, whether prices are fixed at a minimum, maximum, or within some range without any legitimate justification. That is why antitrust law has been implemented by the federal and state government in order to regulate the conduct and organization of business corporations. On the other hand, pricing concerning ethical issues goes beyond simply following the law. To practice ethical pricing, a business must need to spot the ethical issues that hinder fair pricing. Ethical decisions are difficult sometimes because there isn't a defined line for morally right and wrong decisions. As with many ethical problems in business, a company needs to take a step back and view decisions as a greater part of the business community and set ethical standards for their business.
Next, setting retail prices. Under this, we have retail price and markup. Many retailers set prices by adding a markup to the item's cost in order to make a profit. When we say markup, this is the difference between the retail price and the cost of an item. The markup percentage, this is the markup as percentage of the retail price. As you can see in the example, we have a retail price of $125, and using the formula, we must subtract it from our cost of merchandise, which is $75, and then divide with the retail price to get a markup percentage of 40%. And to get the retail price based on the cost and markup percentage, this is the formula. Like for example, a buyer for an office supply category specialist purchases calculator at $14, which is the cost, and needs a 30% markup, and this is our markup percentage, to meet the financial goals for the category. Thus, applying the formula $14 divided by 1 minus the markup percentage as fraction, so we now have the retail price of $20. Next, initial markup and maintained markup. When we say initial markup, this is retail selling price initially set for the merchandise minus the cost of merchandise. Whereas the maintained markup, this is the actual sales realized for the merchandise minus its cost. So this is the formula for the initial markup percentage. Like for example, as you can see, we have our maintained markup percentage of 33%. We simply divided it into 30 cents of maintained markup and 30 cents of maintained markup percentage, resulting in a 33%, and add this to the percent reduction, 11.111%, then divide to 100% plus the percentage reduction, so we have the initial markup percentage of 40%. Next, the use of break-even analysis. Break-even analysis is a useful analytical tool. Thus, retailers typically want to know how many units they need to sell before they can start earning a profit. So this is the formula to get the break-even quantity. So the break-even quantity is the quantity at which total revenue equals total cost, and then profit occurs for additional sales. For example, for calculating break even for a new product using the formula, our fixed cost here is $700,000 divided by the actual unit sales of $12 minus the unit variable cost of $5. So our break even quantity is 100,000 bags. Thus, PetSmart needs to sell 100,000 bags of dog food to break even or make zero profit. And for every additional bag sold, it will make $7 profit.
Is any change to the original price of a product in a retailer's inventory. Price adjustment, also called price protection, is a retail practice in the US in which customers can obtain a partial refund of the purchase price of an item if they can show its sale at lower price within a fixed time frame. Markdown. Markdown is the difference between the highest current bid price among dealers and the market for security and the lower price that the dealer charges for a customers. Dealers will sometimes offer lower prices to stimulate trading. The idea is to make up for the losses with extra commissions. One of the example of markdown is the if a broker sells a security to a client at a lower price than the highest bid selling price in the securities market among brokers, the price is a markdown price. Price discrimination. Price discrimination is a selling strategy that charges customers different prices for the same product or service based on what the sellers thinks they can get the customer to agree to. In pure price discrimination, the seller charges each customer the maximum price they will pay. One of the example of price discrimination is the movie tickets. Prices at one theaters are different for children's, adult, and seniors. The prices of each tickets can also vary based on the day and chosen show time. Ticket prices also vary depending on the portion of the countries as well. There are three types of price discrimination. We have a first degree discrimination, second degree price discrimination, and third degree price discrimination. And we have a price discrimination and an example. We have a coupon, age discount, occupational discount, retail incentives, gender-based pricing, financial aid, haggling. And that is the example of price discrimination graph.
Pricing services. Matching supplies and demand is about setting a supply equal to demand, means finding a price where the quantity of insurance that consumer demand at that price is equal to the quantity that producers supply at that price. A market is any place where buyers and sellers met to trade products. The market price is the amount customers are charged for items depend on demand and the supplies of a product. Demand is the amount of product customers who are prepared to buy at different prices, while supply is the amount of product businesses are prepared to sell at different prices. Supply and demand have an important relationship because together they determine the prices and quantities of most goods and services available in a given market. In general sense, measuring service quality depends entirely on the context and brand promise, and service quality dimensions vary according to the industry. However, the industry standard and most widely used metrics is ServQual. These dimensions defined by the ServQual measurement instrument are as follow: tangibles, reliability, responsiveness, assurance, and empathy. Tangibles are appearance of physical facilities, equipment, personnel, and communication materials. Reliability is about to perform the promised service dependably and accurately. In responsiveness, it's about willingness to help customer and provide prompt service. And in assurance, it's about knowledge and courtesy of employees and their ability to convey trust and confidence. And lastly, empathy. It's about the caring, individualized attention that the firm provides to its customers.
Pricing techniques for increasing sales. There are three pricing techniques that I will be explaining to you. So first is leader pricing, second is price lining, and the third is odd pricing. So, what is leader pricing? Leader pricing strategy is a type of promotional pricing in which the retailers or other small businesses set lowest prices for the products. It involves setting lower price points and reducing typical profit margins to introduce brands or stimulate interest in the business as a whole or a particular product line. Products sold in this strategy are often sold at a loss. This is done to attract more customers to buy the product, and it is also called as loss leader pricing. Examples of loss leaders include selling low-cost computer printers that need expensive ink, and discounting hot dog buns by a grocer who then increases the price of hot dogs. For a loss leader strategy to work, the profits from other goods sold during your loss leader promotion must cover the low profits or losses taken on the featured merchandise. Price lining is the practice of releasing multiple versions of the same product or service at different price points simultaneously. It gives the impression that the product has both budget friendly, standard options, and premium options with extra features and benefits. Price lining is intended to appeal to both higher end and value conscious buyers by giving them a choice between a better product and a better deal. Example for this is iPhone 11 and iPhone 11 Pro were released at the same time. In with this example, for some buyers, the premium model is enticing. They're happy to pay more under the assumption that they're getting a better product. Others are drawn to the standard model. These buyers are willing to take a lower quality product because they feel they're getting a better deal. Ad pricing is a pricing method aimed to maximizing profit by making micro adjustments in pricing structure. It relies on the assumption that consumers are calculation averse and will therefore only read the first digits of a price when making their purchasing decisions. According to this method, the relevant for information of any given price does not usually relate to the last digits, but rather to the first digits. Ad pricing creates the illusion that the product is tagged at the lowest price as possible. For example, a $20 item marked $19.99 is perceived as cheaper because the number is still in the teens rather than the 20s. Even though the difference is in just 1 cent, customers perceive the price as lower than it actually is.
The internet and price competition. Basically, the internet has made many markets closer to perfect competition because the internet has made it very easy to compare prices quickly and efficiently. The internet market possesses the key traits of consumer having perfect information, sellers being price takers, and consumers determining the prices of the products. Consumers have perfect information about products because they can easily go online and look up a review of the product as well as different retailers' prices for the product.